Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Wednesday, the 4th day of June, 2014, and this is the daily report for gold and silver. We have a quiet day, nominally lower in gold, off about $1.20 on the day, unchanged on silver. To gold, current print on the screen is 1243.64. The low has been 1242.20, and the high 1250 even. Silver trading quietly unchanged. The low of the day is 65.1865. The high 18.99. Current print 18.79. More on silver towards the end of the show. Traders, there's no doubt we have witnessed a fairly dramatic sell-off. To me, the important thing was the fact that as it traded over $13, it couldn't sustain that point. And you can see these various tops right in here and here. Of course, we had what we identified as a compression triangle. In essence, we saw a shrinking of range. And the range that we saw compressing was a series of higher lows and lower highs. Market did in fact broke to the downside, and the real question now is whether or not we're going to find some sort of support at the 76% retracement level. Now, in terms of historical data, there isn't all that much activity. We can carry that over this particular line, and you can see that it was in fact a little bit supportive right in this area. And this, of course, is a rally that began beginning of this year, end of last year, taking the market up to roughly 1391. Now, a 61% retracement is really, for any kind of a bullish market or scenario, you wouldn't see a retracement that goes much deeper than that. Obviously, we had any kind of rallies that we're seeing right now have been absolutely counter trends. We cannot identify them as anything else because of the fact that we continually drift to lower pricing. Now, the real question, as I said, is we have this one level here, 76% retracement level, roughly 1232, whether or not the market's going to hold. The one thing is we've seen stabilization of price. Market came down, of course, and you can see for the first time we're starting to get the alternating candle color small-bodied candles. Now, what does that remind us of? Well, if we look historically at the market, let's bring up another chart for that. We can see that for the first time there's some sort of an attempt to go sideways or at least stabilize. When we think of it this way on this daily chart, you can see this was 1435 right up in here. Market comes down, makes this low, and this of course is the second of that double bottom that we identified at roughly 1181. We get our dynamic rally, and that's where we actually go in and create our fib retracement, 91 here down to 1183. The fact is, we said that it broke through 61 is bearish indeed, and the bears are absolutely dominating and have control over the market. What we are looking to see is, are we going to get some sort of sideways trading activity? In other words, form a base in this area, because as I said all throughout the week and a little bit last week, if it does break through 1232, my sense is that it's really got nowhere to go on a technical basis but to maybe retest this 1181, the double bottom. Now, my sense is if that would happen, we're going to hold this, we would have a triple bottom. And if we didn't hold that, that would be a completely different scenario. But my sense is that we could absolutely hold here. If we do not, I really believe the probability is high or substantial that we would hold the 1183, 1181 level. Now, of course, the other chart that we'd want to look at to determine the strength of this current sell-off or downtrend is going to be the Japanese average chart. I've converted the daily chart we just looked at into a Japanese average chart. And of course, we've talked about this many times. What happens with these charts is because it is comparing current price to the midpoint of the prior candle, in this case, the prior day, what you'll see is really filtering out a lot of the noise in the market. So you get a clear definition of trend. Uptrends, solid green. You look for nice body size, absence of lower wick. Same thing with downtrend, solid red. You will get an occasional green, and of course, even on the way down, you'll get an occasional green on the way down and red on the way up. One thing that we noticed as this market was trading sideways is the fact that the market was truly in both candlesticks as well as Japanese average charts, seeing that alternating candle color. Now, I draw your attention to the most recent activity in this last trading week. And let's go ahead and blow this up just a little bit so you can get a better idea of what we're talking about. And this is what we're seeing as follows. If you look at this candle size, because really in the Japanese average, we're looking at two things: the size, relative size compared to prior candles, whether or not it has an upper wick as the market goes down, lower wick as the market goes up. And so what we're seeing here is you get that break, the dynamic break. The next day or candle is extremely strong. You can see that here. You can see the strength of this one. It's larger. And then they start to diminish. Each candle consecutively gets smaller and smaller until the current day. What that tells you is it's still red. Okay, so we still have selling pressure. However, what we are getting is this very, very small body size, and that's typically what you'll see as a market bottoms out or hits a top. And we've seen this occurring many times. Let's go ahead and kind of compress this a little bit so we can take a look at some examples, but we've talked about this before. You can see the small doji right in here. Body comes up here. You really don't, you get a transitional candle, but you don't get that small bodied candle. Here you can see it got smaller itself, and here you get that nice doji cluster. So it will give us an indication of a market that's either consolidating and resting before continuing in the direction, or a potential pivot point. So we use candlestick patterns, Fibonacci retracement, to determine if it's a logical point for a pivot. Now, we're at 43, so we are still a ways from any kind of logical or technical price number. And in terms of historical basis or technical, we can see that as this market came up, it truly found a little bit of support, came up and then traded a little bit sideways. But this is indicative of a market that has support in this area, so trade sideways before completing that rally. In the same way, we might see this market as it moves down trade a little bit sideways, and then the real question has got to be, will it hold this particular area, or will we see it break through? Because as I said, if it breaks through, we really have nowhere to go but 1183. If it holds, we could get a nice little bounce to the upside. And last, I want to take a look at silver. And I'm doing that by looking at a chart that's pretty much a bare bones chart. I've taken everything out and compressed it so we could really take a look at where these recent lows fit in terms of the big picture. Of course, this is going back all the way to 2000 to current date, and it is a weekly chart. What we do notice is that we do have an area in which we had a former level of resistance, and what's critically important about this area is it was right before the market went parabolic. Goes parabolic, we can see the dramatic sell-off coming back to this point, but it's kind of lined back up right at this particular level. So that right now, just as I see a minor level of support but important at 1232 in gold, this in silver is much more critical. A break below this, and there really isn't on a technical basis. We have a couple of different areas to look at, but they're $1 to $2 away. So we'll keep our eye on silver, we'll keep our eye on gold. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.